What's up, everyone? It's Scotty with MoneyVest. So today I wanted to discuss a very interesting headline that came across the articles that I was reading, and also kind of reminded me of how the markets really work and how life really works. So I know it's going to get a little philosophical towards the end, but I wanted to go over a very specific chapter from Psychology of Money from Morgan Housel. So that's what we're going to discuss here in this video. As always, if you enjoyed, find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. I would really appreciate that. And of course, links to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the members only videos. You know, we've got 40 plus tutorials and lectures and videos that are accessible, ad-free content for all the members. Excel spreadsheets, so individual stock intrinsic values. Of course, we got S&P 500 valuations, volatility spreadsheets. Everything's going to be included, as well as Discord channels, trade alerts, find out exactly what I'm buying and selling, and engage with thousands of members worldwide in our Discord as well. So links going to be down below. Also, don't forget fundamental technical analysis courses, options courses, psychology of investing course. Also, all of them available with the link down below. Lifetime access, and do also connect with me on Instagram. My handle is going to be CASWRP as well. So this right here was the headline: the 25 best stocks by shareholder wealth creation in the last almost 100 years, so 1926 to 2022. And again, we're going back almost 100 years. And before I actually jump into the actual stocks themselves, there's another headline that just 20 stocks on the S&P 500 are responsible for nearly all of the gains this year as big tech leads the rally. Okay. And there's this concept for tail events that Morgan Housel talks about, right? So tail events, basically, if you take a look at the probability distribution or outcome distribution of any sort of a situation or circumstance, you'll notice that, obviously majority of the outcomes live right in the middle, in the average and the median. And the left tail, right tail basically, describes the low probability outcomes, right? These are very, very rare events, right? That nobody really can predict, nobody really knows, but these are the ones that actually move the needle. These are the ones, the tail events are the ones that actually make all the difference in the world of investing and in the world in general. And what I mean by that, we're going to come back to this infographic of 25 stocks, but according to Morgan Housel, what he says, a tail event is a rare and an extreme occurrence that has a significant impact on the outcome of a situation. Okay, so tail events are once again very, very rare, and these are extremely unlikely events that actually do end up happening and of course end up making all the difference in the world. It is an event that lies at the tail end of a probability distribution, just as I showed you, and has a low likelihood of happening, but when it does, it can have a significant impact on the outcome as well. And examples of tail events in the financial markets include stock market crashes, global financial crises, and other major market disruptions. These are events that are often difficult to predict and can have a significant impact on investments and portfolios as well. And it's at these tail events, it's literally at the core of these tail events where majority of the money is made. The actions you take at these tail events dictate how well you perform and do over the long term, right? So think about all the global financial crises and the financial market crashes and the stock market drops we've seen are tail events. If you kind of look at it from a long perspective and a lens of over 100 years, 200 years, every time there's been a tail event, people who took the advantage of those opportunities and were dollar cost averaging or buying and were very aggressive in their approach ended up doing really well because markets have performed really well since then. And of course, these tail events have come and gone. The S&P 500 rose 22% in 2017. Now, these are just some examples that I want to go over and kind of help you understand that how crazy and how deep these tail events can really be. So S&P 500 rose 22% in 2017, but a quarter of that return came from 5 companies. Think about that for a second. 25% of the overall returns came from 5 companies alone. And this year, nearly all the returns have come from just 20 companies. And back then, there was Amazon, Apple, Facebook, Boeing, and Microsoft. 10 companies made up 35% of the returns. 23 accounted for half the return. Really, 23 return basically accounted for 50%. And Apple alone was responsible for more than the index's total returns that the bottom 321 companies combined. Okay, S&P 500 has gained over 108% over the last 5 years, and 22 companies are responsible for half of that gain. 92 companies made up 3/4 of the returns. In other words, 92 companies make up over 75% of the returns. And the NASDAQ 100 skews even more, with the index gaining 32% last year. This is, again, as of 2021. So this actually came out in 2022. And 5 companies made up 51% of the return, and 25 companies were responsible for 75% of the overall return. So basically what we're seeing is a very, very, very small percentage of companies making up majority of the gains and the returns that we see. And to take things even further, what you'll notice is Google's hiring acceptance rate is 0.2%. So in other words, how many people get employed versus how many people apply for the jobs at Google. And Facebook and Apple, these acceptance rates are really, really low. And these are the people that are working on these tail projects, that are driving these tail returns, that have tail careers. And that's what's driving these tail returns in the markets as well. And Warren Buffett also once said that he's owned over 400 to 500 stocks during his life and made most of his money on only 10 of them. Think about that for a second. 500 companies and he's only made money on 10 of them, right? So that is about 2%. 2%, right? So 10 divided by 500, 50 would be 10%, 10 would be 2% of all the gains that Warren Buffett has made owning 500 stocks. It's only come from 2% of his companies. And Charlie Munger also followed up, and he said that if you remove just a few of Berkshire's top investments, its long-term track record is pretty average. And of course, the postscript of Intelligent Investors describes partnerships investments in one stock as well. Now, a takeaway from this is that no matter what you're doing, right, you should be comfortable with a lot of stuff not working, okay? We plan, right? Morgan Housel in the Psychology of Money also talks about that you need to plan for your plan not going according to plan. And that is because whatever we plan or whatever we forecast or foresee for ourselves and for our future and for our investing career, it's possible that it may not work, right? Stuff may not work. It's normal. And that is true with companies as well, which need to learn how to fail well. Because a lot of these companies, you'll notice Amazon is running on AWS. It's running on advertising, which in itself came after hundreds of trials and errors for different products and different services, right? Which was in itself being driven by tail people that have tail careers, and that eventually ended up being very successful. And it's now driving the tail events, the tail returns within the market. It's true for investors who need to understand that both the normal tail mechanics of diversification and the importance of time horizon as well, since long-term returns accrue in bunches. And it's important to realize that jobs and even entire careers might take a few attempts before you find a winning groove. And that's how these things just work in general. So very, very important to understand the beauty of these tail events. And I think it's important for us to recognize when these tail events happen so we can take advantage of them at the right time. Because most of the times, obviously, it's kind of like the tail events are rare, so you'd understand that they don't happen very often, right? It's kind of a given, right? The reason why it's called a tail event is because it's rare. So you're not going to find these opportunities very often. But the moment we do, we just have to be ready for them and take advantage of them as well. But anyway, going over to 25 best stocks of wealth creation since 1926 all the way through 2022. Of course, Apple is going to be at the top of the ranks. Apple created nearly 5% of all shareholder value, rising from a market cap of $1.8 billion to $2.1 trillion as of December 2022. ExxonMobil's up there. Microsoft is up there. Alphabet is up there. We got Chevron. We got Johnson & Johnson, Amazon, Berkshire Hathaway, Walmart. We got Procter & Gamble, IBM, Altria, Merck. We got Home Depot, United Health, Oracle, Eli Lilly, JP Morgan, Coca-Cola, GM, General Electric, Pepsi, Pfizer, MasterCard, and Visa as being the companies. Tesla and Meta are not part of this list just yet, but these are the companies that have been responsible for majority of that wealth creation in the markets over the last almost 100 years. So, and again, another really important statistic that I want to go over is these 25 companies are from a list of 28,000 companies. 28,000 folks, 28,000 publicly listed US stocks. The top 25 have created nearly a third of all shareholder value. So over 30% of all shareholder values come from only 25 stocks since 1926. So if you do the math, 25 divided by 28,114, we are looking at less than 0.1%. Less than 0.1% of stocks have created 33% of the gains in the markets over the last almost 100 years. So that, if that's not a tail event, I don't know what is. So hope you all enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below. It's a little bit more educational as well, kind of going over a very important lesson that a lot of the things that we do in life and investing and just everyday stuff and career-wise is driven by tail events. Tail events, even though very rare, are the ones of significant importance, and they're the ones that are driving all the future returns and the outcomes in our lives. So I hope you all enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Do connect with me on Instagram. Handle is going to be CasWRP. Fundamental, Technicals, Options, and Psychology course available with the link down below. Lifetime access. And also do check out our Patreon and Discord if you want to join, be a part of our MoneyVest community. And as always, happy investing, and I'll see you all in the next video.